There's no point making wealth slowly, and by the time you earn your first million, you're already 60, 70 years old. You do not have the time and or energy to actually enjoy the money anymore. My name is Chong. I'm the Group Vice President for IQI. I'm also the founder for Eliteone Group. Today, we'll talk about the fast lane to millions. Different paths to wealth. I'll talk about the three paths, okay? The first one is called the side lane. The second one is called the slow lane. And the third one is called the fast lane. So what are the three lanes? The first one, side laner. In life, there are people who are on the side lane. They just see no action and always complain. So you always face this kind of people that always complain about everything. They complain about government, they complain about they do not have enough money, and then they're just not doing anything to fix the problem. So these kind of people are problems oriented. They are not solution oriented. So these people normally will not be rich. So these are what we call the side laner. Of course, we do not want to become the side laner. We want to become the fast laner. But in the middle, there's another group of people called the slow laner. They follow the conventional wisdom. Most of our parents told us, study very hard, go to a good university, get good grades from school, come out from school, get a good job, work very hard, earn a lot of money, save a lot of money. This is good wisdom, but somehow there's certain myth behind it. So let us do some mathematics here. How long does it take to become a millionaire if you follow the conventional wisdom? Let's say 1 million ringgit Malaysia. Yeah? Imagine you can save half of your income every single month. Let's say you save 3,000. 1 year you are saving 36,000. If you take 1 million and divide that by 36,000, you need to take 27 years to have your first of 1 million in your bank account. Let's say you are 13 years old right now. You're already 57 years old. You become an old millionaire. So this actually does not work. Why? Because the growth of wealth is too slow. And of course, the fast lane is about cash cow and investment. How you can leverage on these two things to become wealthy person. What's cash cow? Cash cow is a money generating activities that do not have an upper limit. So that cash cow is better than salary because now the harder you work, the faster your money come. So once you have made the money, where do you want to put the money will determine whether you become wealthy or not. So today we talk about the three investment vehicles: properties, shares, a bit of business, and also cryptocurrency. To build wealth, there's one very important concept that we need to understand, which is the compounding effect of your asset. Meaning, when you put this thing into that investment vehicle, it produces an income. Okay, either it's capital appreciation, or it's a rental yield, or it's an interest. So when we make enough money, we need to allocate our money into all these things. I can't just say, oh, if business is 20%, I put everything in 20%. If cryptocurrency is making good money, I put everything in cryptocurrency. Because you really can't put all eggs in one basket. Let me show you a table. Every year, you put 10,000 ringgit into an investment vehicle, and that investment vehicle can produce 10% return on investment for you. At the end of the year, you get 11,000. You have to understand this concept. On the second year, you put another 10,000 in, and on top of that, you have the 11,000 from the previous year, and that compound 10%, you get 23,000. So if you do this for 10 years, let's say I put 10,000 only per year for 10 years. At the end of 10 years, you get 175,000. But if you look here, by the end of 20 years, you get 630,000 by just putting 10,000 in. So there are two determining factors over here. One is the interest, which is a compounding interest. Second, which is your initial investment that will determine after 10 years how much money you are going to have. If you are a salary owner, you have to save very, very hard for 20 years. Then only you have 2 million. 10 years is you have 300,000. To get the initial investment in at the right amount, you have to have a strong cash cow. You can't just earn a bit of money, put a bit of money and expect a big return. That's nearly impossible. To become wealthy, first you need to build your golden goose. Then the golden goose can lay golden eggs. This is why we need to buy properties, we need to buy shares, and we need to buy other investment assets. Okay, let me show you some examples. So I'll talk about this look. The boss of this, he actually have to drive out and then sell the look to make the money. Equivalent to exchanging his time for money. But once he made enough money, he actually invested to buy more cars. So every day, a lot of people driving these lorries go to many places in KL or in Selangor to sell lok. So this uncle, from selling lok himself, to buy a lot of cars, and then he actually set up a business system to do profit sharing with the one who drive the car, the drivers. So if you look at this figure, one day 150 ringgit, he has 40 cars. So one day he can make 6,000 ringgit. 1 month he can make 240,000 without having to drive the car out. So second part, we look at properties. Okay, so why invest into properties? This is very important. Properties is a very good way to hedge against inflation, because property price will grow faster than the inflationary rate. Let's say inflation is 4%, property most likely will grow 5%. You may look at a property, you can decompose it into certain things. Okay, one is the land cost. Second is the material cost. Meaning, we want to build a property, you need to buy materials, right? And the third one is the labor cost. To build a property, you need to hire labor. So when all these three things increase in price, your property price will increase, definitely. Second, which is a very important point, is your ability to leverage. Property is the only asset that the bank is willing to give you a 90% loan on the 35 years tenure. And when you make the money, you don't have to pay back the bank. You only pay the interest. The third one is rentable. Your property can rent out. Okay, if you buy share, you can rent your share. If you buy gold, you cannot rent your gold out. So property is the only asset that you can actually rent it out and let someone pay for your installment. If you look at cryptocurrency and a lot of other investment, it can go up and down very, very fast. And one day you can lose 50% of value. But that does not happen to properties. Property value is relatively very stable. It will go up, it will go down, but the wave, the amplitude is smaller. So you can have a peace of mind, especially when you invest into the correct property. So the third part, we'll talk about shares. Share is a very interesting investment vehicle. So before we want to talk about shares, we need to understand what is a share. A share is a slice of a company. Meaning, if you buy a share of a company, you actually own a piece of the company. So that's why a share is a piece of ownership of the company. There are very important concepts to understand when you invest in share. One is called a company valuation. The other one is called a company earning. What is company valuation? What is company earning? So when we talk about a company, it has a market cap that's 934 billion. So the company valuation for Facebook, okay, is 934 million. And it has an earning also. What is earning? Meaning how much profit it can make for that year alone. And there's another very important concept which is called the PE ratio, which is a share price or the company valuation divided by the earning per share or the earning of the company. If you look at any information about a company, definitely you'll see this thing called PE ratio. Okay, for Facebook is 28, meaning the buyer is willing to pay 28 times the earning of that company to buy the shares of the company. And the market will determine the company valuation of a public listed entity. When you want to invest in shares, you have to look at the long-term potential. A lot of people, they invest in shares, they look at the short-term gain. Now, the fun part, cryptocurrency. Cryptocurrency is a digital currency. Some people are not comfortable with this kind of money, which is centralized. So they come up with this technology called the blockchain technology, which is a decentralized system whereby nobody controls any of the coins. If you have Bitcoin right now in the market, actually it is not controlled by anyone, it's actually controlled by the entire market. Okay, so it's a digital currency that is controlled by everyone. What's the fundamental behind cryptocurrency? Actually, to me, it's like gamble. If you go to Genting and then you win, does it mean that your trade in that gamble have value? I think it does not have value, it's just that you are lucky. Can you make money from cryptocurrency? Yes, definitely you can. But my philosophy is like playing Toto. If you have spare cash, you can buy some of the coins and put there for like a few years, then definitely you will see some profit. But if you want to go all in, I will strongly against it. If you really want to do crypto investment, do within your capacity. Do not play margin, do not play futures, do not play options. If you do that, you lose all your money. For cryptocurrency, there are two ways to earn money. One is hold on to your dear life, hoarding, meaning you put money in there and then you don't look at it for a few years. The other way is to do trading, meaning you catch the wave. You buy here, sell here, buy here, sell here, buy here, sell here. But this one takes a lot of time. So I do not advise you to do that. I advise you to create a cash cow meaning you do your own sales, okay, earn a lot of money, build a team, build a system, generate a lot of cash, and put the certain amount of cash into properties, into shares, and 10% into risky asset, cryptocurrency.